So we have an analysis report that lays out a very ultra-bullish technical case for IREN. And it's targeting $60 with a momentum breakout strategy.
Right, and you see it immediately. The conviction is high, the key levels are incredibly sharp. For a play like this, that's a huge asset.
That actionability.
Exactly. But when you're aiming for a target as ambitious as $60, and you're saying it starts today, we have to be sure that the entire logical framework is, bulletproof.
Okay, so let's start right there with that framework. Let's talk about risk. The report defines the downside pretty clearly. There's primary support at $39.92, a critical floor at $36.90, and then a really tight stop loss at $38.50.
And look, the downside risk assessment needs to match the intensity of the ultra-bullish upside projection to maintain logical rigor. What's laid out is great for a tactical position.
For protecting against a daily reversal, that kind of thing.
Yes, absolutely. The weakness, though, is that the whole case rests on this continuation breakout idea, but it doesn't really have a fully developed, let's call it an invalidation thesis.
An invalidation thesis. So what happens when the entire narrative just breaks?
That's it. What happens when the momentum itself structurally fails? That stop loss is tactical. It protects you for the day. But if price breaks that critical floor at $36.90 and stays there, what's the strategy then? There's a big gap.
I think that's a really crucial distinction. It's managing a little hiccup versus the whole investment thesis just, evaporating. The $38.50 stop protects capital, but if $36.90 is the critical floor.
Then why isn't the failure to hold that floor the real exit signal?
Right.
A trader has to know not just what they might lose, but when the very reason for being in the trade is gone. So the suggestion is to clearly define what nullifies the entire breakout idea. You need a framework for abandoning the thesis.
So you're almost asking for a second parallel strategy, one for aggression and one for when things go wrong.
I think you have to. Otherwise, you create the psychological trap where someone might just hold on, hoping. We need to close that loophole. So a concrete example would be to add a clear line in the sand. Something like,
if IREN closes below the critical floor,
the momentum thesis is invalidated. The trade is a failure to launch. Exit all positions. Simple as that.
And for the swing trader that the report mentions, the one who might be buying on dips,
for them, you need a different path, a contingent pivot. For instance, should the breakout fail, all accumulation stops. The focus shifts from a momentum chase to a longer-term value entry.
So you're not just getting out, you're changing your entire mindset.
Precisely. You're saying, okay, the new target for re-entry might be down at major structural support, maybe near that $30 floor. It shows you've thought through all the possibilities.
That really adds a ton of depth. Okay, let's flip to the upside then. The fundamentals. The report talks about a big valuation reset. PE around 23, 300% plus revenue growth, and this new identity as an AI cloud play.
And the targets are 48.50, 55, and then the big one, 60, which is defined as a Fibonacci extension.
Yeah.
And here's the next point. Strengthening the linkage between that fundamental fuel and the ambitious $60 price target would make the whole play more intellectually robust. The fundamentals section is fantastic. It gives you a great reason why the stock should go up.
It sets the direction.
It sets the direction, but the weakness is that it doesn't analytically connect those great metrics to the $60 target specifically. That $60 number is just technical. It's a Fibonacci level.
Okay, but isn't that pretty common? You use fundamentals to say this is going up, and then you use a technical tool like Fibonacci to find the targets. Why is that a problem here?
It's a problem of credibility, really. For a move of this size, a 50% jump, the analysis has to show how the fundamentals justified that specific valuation. The chart has to meet the math. If your fundamental case only really supports $50, but your chart says 60, then that $10 gap feels arbitrary.
I see. So it's about making the target feel inevitable, not just possible.
Exactly. The suggestion is to weave that valuation story directly into the price target section. You need to translate the growth and the multiple expansion into a valuation range that actually validates that $60 level.
Okay, so how do you do that? How do you quantify the narrative?
Well, first, you quantify the multiple expansion. You could say something like, given this shift to an AI cloud play identity, a conservative PE ratio of, say, 35 to 40 could be justified based on its peers.
Okay, so you establish a new justifiable multiple.
Right. And then second, you show how that new multiple gets you to the target.
You connect the dots.
You connect the dots. This multiple expansion is what's needed to support a fair value in the $58 to $62 range. And then you can say the $60 Fibonacci level is a key confluence zone where the technicals meet the fundamental potential.
Now the $60 target feels calculated. It's not just a line on a chart.
It feels earned. And that's the kind of rigor that elevates an analysis.
That makes a lot of sense. All right, let's move on to the last point, which is more about presentation. The language in the conclusion. It's very vivid. Phrases like, Wall Street was wrong, mathematically programmed into the charts. And my favorite, I am loading the boat on dips.
Yes. And look, the point here is that realigning the highly emotive language of the conclusion with the precise, data-driven nature of the analysis will boost the overall analytical credibility of the report.
You're talking about a tonal shift.
A big one. A kind of tonal whiplash, really. You go from this very objective, numbered analysis of price levels, 4250 breakout zones, VWAP watches, to this. Highly motivational, almost rhetorical closing.
But isn't some excitement necessary, especially for a momentum play? If the analysis is solid, why is saying I'm loading the boat so bad? It shows conviction.
It shows conviction, but it does so by introducing a subjective bias that the rest of the report worked so hard to eliminate. The goal is to motivate action through a synthesis of the data, not just pure emotion. The suggestion isn't to remove the confidence, it's to ground it in the evidence you've already presented.
So maintain the conviction, but lose the hype?
That's a good way to put it. You need to keep that analytical voice consistent all the way to the end. So for example, instead of saying the path to 60 is mathematically programmed into the charts.
Which sounds a little deterministic.
Right, you could summarize the convergence of your signals. The alignment of the volume profile, the breakout, and the valuation floor suggests the market is rapidly repricing IREN's new AI narrative. It says the same thing, but it's based on your evidence.
Okay, and what about the call to action? How do you replace loading the boat?
Well, instead of that personal, subjective statement, you can conclude with a precise action summary that actually reinforces the discipline you talked about earlier. Something like, given these converging signals, aggressive entry is warranted within the buy-the-dip zone while strictly adhering to the stop-loss protocol.
So it brings it all back to the strategy, not just the emotion.
It makes the entire report feel integrated and trustworthy from start to finish. It's a clean, professional capstone.
That's a fantastic point. It really ties everything together.